So you may have heard from a family member, a friend, or a coworker use the term HELOC, and you're wondering what the heck is a HELOC, right? And how does it work? So in this video, I'm going to explain what is a HELOC, how does it work, and what are some of the more common use cases for why even people get a HELOC in the first place. So that being said, what's going on, guys? My name is Sam Kwok, one half of the Kwok Brothers, and I've been consulting finance, real estate, investments for almost a decade now. And just like what I mentioned, I'm going to go explain and give you guys the best simple definition of a HELOC, which is an abbreviation for a home equity line of credit. So let's go and start there. What is a HELOC in the first place? Now, a HELOC is a type of a loan you get from a bank, a credit union, or other ancillary lending institutions. So a HELOC works very similar to a mortgage. In fact, a little funny joke that I like to say is a HELOC is kind of like if your mortgage and your credit card had a baby. There's similarities of a mortgage and a credit card, and that's how typically HELOCs work. So what do I mean by that? Well, if you look at a traditional mortgage, it's known as a closed-ended loan, meaning with a mortgage, obviously bank gives you a lump sum money. They charge you interest over time, typically for 30 years, and you use that to obviously buy a home, right? There's two types of payments you make, interest and principal. They're typically combined. That's a mortgage. And it's closed-ended because when you borrow for a mortgage and you pay it back, you can't borrow again unless you refinance or do a cash-out refinance. Whereas a home equity line of credit, you kind of get the best of both worlds. You get lump sum money from your equity of the home, and you also can borrow and pay it back just like a credit card. So it is known as an open-ended revolving line of credit. Again, simply means that you can borrow from the HELOC, pay it back, borrow again, and pay it back. And of course, any portion you borrow from the HELOC is subject to interest that you'll pay. And in many times, the banks only require that you make interest-only payments, which of course, you don't just want to make interest payments. You also want to make sure you have principal payments as well. So those are the main key differences with the HELOC and a mortgage. Some additional similarities with a HELOC to a mortgage is that your HELOC will also use your home equity as a collateral, which means that the line of credit will be tied to your home. And if you stop making payments on the HELOC or you fail to make payments, then of course the bank or the credit union has the right to take your home through the process of a foreclosure. Very same process with a mortgage, right? With a mortgage, you stop making payments, then the bank could potentially file foreclosure and you lose your home. So there's some similarities there in terms of both a mortgage and a home equity line of credit. They use your home as a collateral. Technically, in the banking world, if we're going to go there, your HELOC is actually a form of a mortgage. It just uses a line of credit as a way for you to interact with the loan, essentially. So those are the main differences and similarities to kind of draw upon and give you some explanation as far as how does a HELOC work. Now, let's talk about some common use cases as far as how do people even use HELOCs in the first place. Is number one, the most common ways I've seen HELOCs work is that homeowners will take out HELOCs from the bank. They'll go through the application process. Depending on the first lien position or second lien HELOC, the application process may vary, which I have a whole entire separate video explaining how a first lien versus a second lien HELOCs work. So definitely go check that out. But they'll typically go and get a HELOC to do home renovations or home remodelings. Let's say you want to go and redo your kitchen, new cabinets, appliances, and so on. One of the more common cases I see as to why homeowners get HELOCs in the first place is to go and fund their renovation, right? $20,000, $30,000 at a time. I see that quite a bit. Second reason, or number two common ways that a HELOC is used is to consolidate debt. I see a lot of my own clients and other homeowners use their HELOCs to consolidate their credit card debt, or they may have other furniture debt, personal loans, consolidate all of that into a one simple low interest loan. Now, HELOCs typically, the interest rates can range anywhere between 4 to 7%, at least at the time of this recording. Obviously, when the interest rate's lower, HELOCs tend to be lower as well. If the interest rates are higher, it's generally true with other loans as well, HELOC, mortgage, credit cards, and so on. The other one myth that I do need to bust here, and while we're on this topic, is that a lot of people believe that all HELOCs are variable rate or the interest rate's variable. That's simply not true because I've seen cases where HELOCs do have fixed rate interest rates, typically with the first lien position HELOCs, which again, we can talk about that in a different video. So yes, HELOCs can come in variable interest rates, also fixed rate interest rates, they do exist. So just want to get that out there because that is one myth that I see time and time again that a lot of homeowners tend to see. But again, there are a variety of different types of HELOCs that are out there they can get. So that's number two reason as to why homeowners get HELOCs in the first place is to go consolidate debt, take high interest rate credit cards, and consolidate and put it all together with a low interest rate home equity line of credit. So that's number two. Number three common ways that I see quite a bit is using HELOCs to paying off your mortgage faster. And there are methods and concepts that allow you to take a HELOC and pay off a mortgage in as early as 5 to 7 years, even though the HELOC interest rates might be higher, maybe by a whole % or two compared to a mortgage. I've seen scenarios where HELOCs, when used the right way, can help pay off a mortgage, even though the interest rate's lower on the mortgage and faster, and then saves money, saves time. I see that being used quite a bit by individuals that want to get rid of their mortgage payments, want to accelerate towards retirement, accelerate towards investments, and so on. So that's a third use case I see quite a bit. In fact, we have an entire video series just on that topic of paying off your mortgage faster using a home equity line of credit. So you can definitely check that out. If you're on YouTube, go to our channel, subscribe to our channel. We have a ton of videos about it. If you're watching this on Facebook, we have playlists, and check out our profile because we have videos about that topic as well. So that being said, hope this video was very helpful, simple enough for you to understand what is a HELOC, how do HELOCs work, and some of the best use cases for HELOCs. If this was valuable to you, definitely subscribe and follow. I would love to give you guys more value, teach you more things about finances. That being said, we'll see you in another video. Take care.